Distribution provided by Cloud Sigma, the cloud that adapts to you. Visit cloudsigma.com/thisweekend for a free $200 credit.
Hey everybody, it is our startup of the week, sponsored by our friends over at Walker Corporate Law, and boy do we have a great one today. Upstart is I would almost say controversial, but I think brilliant. Some people are wondering about this idea. There's a lot of buzz about it. What's the idea? Basically, we're going to hear about it today, but you can get a loan and then repay it back with a portion of your salary. So people can invest in you. And boy, have people invested in Upstart. People like the Crunch Fund, Mark Cuban, Google Ventures, Rick Miner over there, Kleiner Perkins, New NEA, New Enterprise, and First Round, my good friend Josh Koppelman over there. So this is an all-star list of investors and a really unique idea from the guy who was the president of Google Enterprise. That's all the Google app stuff. So we got a really smart guy with a really great idea, with a little bit of controversy. It's going to be a great episode. Stick with us. Hey everybody, we're back, and this is This Week in Startups. If it's your first time here, let me explain to you what we talk about. Startup companies, building new products and services that change the world, or at least attempt to. Most startups fail. That's right, most of them fail. But when they do succeed, they change the world, and that's why we're all in it. That's why we're resilient entrepreneurs who fight through all the challenges to try to just make something interesting in the world that makes life more delightful, more rich. That's what this is about. That's what startups are about. That's what founding startups is about. Now, if you don't want to go through the hardship of waking up every day and trying to solve problems and make something that makes the world a little bit better, that's okay. That's most of the people on the planet. In which case, please stop listening to the program and turn on Ricky Lake or Dr. Phil or go watch the Walking Dead reruns. We don't need you here. This is the place for people who are either changing the world by building great products or who are thinking about doing it. And our goal with this program is to share with you exactly how to do that. How to raise money for your idea, how to build a prototype, how to select an idea, how to deal with getting your ass kicked in the market by a competitor, how to deal with getting your ass kicked by not being able to raise money. How about if your product sucks, if your design sucks, if the users are pissed off at you, whatever the challenge is. That's what we try to work through here on this program, and we're able to do it thanks to the support of our partners. In this case, it's the Walker Corporate Law Group. Scott Walker is a friend of mine. You can follow him on Twitter, Scott Ed Walker, and they have been supporting entrepreneurs for a while now. They have a ton of lawyers at their boutique law firm that have 10 to 20 years experience at the biggest firms, but they're not going to put any junior associates on your project like some of those big mega law firms do. No, they're going to give you fixed fees. So they're going to tell you exactly how much you're going to spend on raising your A round, raising your angel round, doing a non-compete, whatever it is. And Scott believes that billable hours reward inefficiency, so that's why he does fixed fees. And it's really like the Walker Corporate Law Group is in it because they're passionate about startups. They're not trying to ram and jam you with huge bills. And so many people who are on the program have called Scott and gotten a great result working with him. 310-288-6667. 310-288-6667. WalkerCorporateLaw.com. Go check him out and give him a call. That's his direct line, 310-288-6667. He's a great friend of the show. He's been sponsoring for a long time and partnering on it, and everybody says great things about them when they work with him. Go ahead and thank @ScottEdWalker on your Twitter account. Okay, today on the program, Dave Girouard is with me. Dave, you worked at Google on Google Apps, which I am a huge fan of. How did you wind up at Google?
Essentially, my last company which was a startup called Virage, got acquired by a now infamous company called Autonomy. And I was on paternal leave, and they sent me a note and said, "Don't come back. We don't need you as our VP of product or marketing and such." And so ended up trying to figure out. While
you're on paternity, they'll just send you an email. Wow, that's not nice.
Yeah.
Why do big companies do things like that?
Just a really classy operation, basically.
Why wouldn't they just bring you in and be like, "Hey, you've sold your company to us. Yeah. You've been such a great loyal soldier. We're going to wind down your position, but we want to take you out to a lunch and just appreciate and celebrate everything you did to make this successful."
Well,
What would the cost of that been? A lunch?
Exactly. In the end, it got me to Google, so I think I owe them a lunch. But
Exactly. So how do you wind up at Google? You get a call from them? They're like, hey, you're just like an awesome product guy. Come here.
Well, Google was, this was before the company was public, and it had this notion of an enterprise business, which was really this yellow search box, some people might remember.
Oh, yeah, you could buy the search appliance.
Exactly. It was the only thing from Google at the time you could actually touch, which made it unique.
Right. Or buy. Aside from ads. It was a physical product from Google.
Yeah, and so I got brought in when, the ads business was really in full bloom by then. It was already more than $1 billion business, but they had this thing that they didn't quite know what to do with, and Larry and Sergey liked it enough they didn't want to kill it. So they basically came in and said, why don't you go figure that out? And I said, I don't know anything about enterprise whatsoever, and they said, that's okay, you can probably figure it out, so go ahead. And anyway, over time, Google Apps became the focus of the effort. It was only a month after I got there that Gmail came out.
And boy, was that spectacular, huh? Remember people begging for invites?
Yeah, I don't know if it was our brightest day, because the April Fool's thing, people actually didn't know whether we were kidding or not, right? So
I remember that day. I was in New York at John Brockman's office, my book agent, and he's like, no, it's real. And he showed me because Sergey had given him an account.
Yeah.
But it was a big debate if Gmail was real.
Yeah, no, it was, a gig inbox was unheard of at the time, so it was a crazy thing. But it took us years to turn it into a business product and such, which it's become pretty big at now.
Yeah. And what did you learn there 8 years inside the Googleplex, building products?
I think the awesome thing about Google to this day is that just the level of ambition is unparalleled, I think. You would go into Larry and say, like, hey, I want to, cure the common cold in 8 weeks, and it'd say, that's ridiculous. Why can't you do it in 4? Or, so there was this, the thing I found, just this sort of bare ambition and breathless willingness to sort of always say, no, we can do this bigger, bigger, bigger. And I just found that to be refreshing, and I think it's what keeps the company moving at the pace it's moving even today.
It seems like they've accelerated this ambition now. I mean, since they're printing money, like literally printing $10 billion a quarter with the ad business, now they're really institutionalized the moonshot philosophy, which was, of course, Larry's predilection back then, but it's become institutionalized, hasn't it?
Yeah, well, since Larry took over, he has dialed that up. I think his biggest fear is Google becoming middle-aged and boring, right? And he said again and again, there's no reason big companies should be risk-averse, because they can actually take some hits. When you're small and tiny, there's actually some reasons to be risk-averse, because one mistake can put you out of business. But, now he says they can afford to take a lot of risk and do it in a smart way. And so his biggest concern is the company gets risk-averse, slow, stodgy, and doing incremental things. So I think he puts about 99% of his energy into making sure that doesn't happen.
I have to say, congratulations on your tenure doing Google Apps, because I am a huge fan. I have run 4 or 5 startups on the system. Google Drive, obviously, and I'm starting to use the presentations. I use the spreadsheet. I find there's only 1 or 2 moments a year when I have to use Microsoft Office now.
Yeah.
Can you guess when that is?
Legal contracts.
I do get them from legal contracts, you're right. But I do now convert those legal contracts into Google Docs. There's one other instance when I use it.
I can't, maybe a footnote? No, we added footnotes. It can't be that anymore.
It's spreadsheets.
Yeah.
Sometimes the spreadsheets get so complex that Excel but it feels like they're so close. I mean, for $50 a month, for $50 per year, is that still the price now?
That's right, yeah.
You can put a 100-person organization, have them up and running. It's unbelievable. $2,500, you could have 50 people working in the system. And Office would have been $400 a seat?
Yeah, exactly. It's the price is compelling, of course. I think just what it unlocks in terms of how fast people work together and just get, things that may seem trivial, just we have to get something out in 2 hours, and boom, 8 people can jump on from anywhere and make it happen. And that's sort of very ad hoc ability to just make something that may not exactly be the center of your business, but just tons of little things. Just the speed at which you can move, I think, is what really makes it interesting. And frankly, when you're producing documents, it's not about how beautiful they are. It's just how fast you can get them. Do they do the task at hand? Can you move on to the next thing, right? And that's what I think. That's what I think we brought to the table, is this notion of speed.
What do you think of the Chromebook stuff? And then we'll get on to your new startup. I noticed, I always was I love Google Chrome. I think that's just the fastest browser. But the Chromebook boy, does that last one look really interesting. Instead of them having this sort of cheap feel like their netbooks, there's a $1,500 one with the best screen resolution of any laptop out there. What do you think of that strategy?
Well, I think, for sure they wanted to show that Chromebook doesn't equal, cheap laptop,
Right.
that you can have an incredible experience. It doesn't necessarily mean that's the high point of sales, is meant to be a device that's over $1,000, which is, as you know, is a relatively small part of the market. But having said that, I think there's something really exciting about saying, like, let's dispense with this operating system designed 20 years ago and start with something that's designed with the internet and connectivity and, perpetually being online as built into its design from the start. You get to rip out a lot of junk. You get to just start clean. And I think that notion is, playing out with Chromebook space. And they're getting, adopted in schools in droves because they're trivially easy to maintain. They don't have blue screen of death. They don't have, patches and all this kind of stuff that teachers for sure don't have time to worry about.
And the teachers don't really want the kids having the ability to install a bunch of crazy software. It's like, keep it in the browser.
Oh, a stateless machine is perfect, and it's cool because God knows you don't want crap installed on there or cached on there or whatever. And
that's what I hear. Schools are just going to Google Apps in droves. Is Google Apps free for schools?
Yeah, we decided way at the beginning that it would just make much more sense for us not to try to charge schools. We kind of just did a spreadsheet for about 30 seconds and said, we'd much rather produce users who are coming out of schools and saying, if you make me use Lotus, my head's going to spin around in a circle. Right. And that's really actually playing out now because we've been at it for, I can't say we anymore actually, but they've been at it now 6 or 7 years, which means a huge fraction of the people that are early in the career in the workforce, they were using Google Apps at school, and that's what they're used to.
Yeah. Hey, so let's talk about your new startup, Upstart. Is it upstart.com or upstart.org? What do you have?
Upstart.com.
You got a great domain name there, huh?
$5K.
Only $5K?
That's it.
Wow, well done. So tell me, what is the mission of Upstart?
Upstart is essentially helping people invest in themselves and do what they really ought to be doing with their lives. And in short, the notion is people earlier in the careers make suboptimal decisions. And by suboptimal, I mean typically they have something they're really excited about, they're passionate about doing, but which I guess is entrepreneurial in the broadest sense of that term. But instead they go with plan B, which is take a job that they're not really happy about or excited, but they have to pay their student loans, they have credit card debt, their parents want them to take the job, et cetera. So the observation that led to Upstart was, these people who Google would hire in droves or, had come up with algorithms in order to hire them, you can measure their potential. You can see what they're likely to do over the course of their career. So why not let them, in effect, borrow from their future selves and take 30 grand or 40 grand from their 30s or 40s and pull it into their 20s when it actually can have a much larger effect. It can allow them to retire some student debt, maybe learn how to code if they want to go to, General Assembly, one of these hacker academies, or obviously work on a startup. And that's the notion is these, I was sitting at Google, a friend came to visit, we were talking about this idea, and I literally on my phone went and I reserved the domain liquidgrad.com. Which was my first notion is these college grads are illiquid. They have short-term financial squeeze, and they're pushing them towards taking jobs they don't really want, which, by the way, there's not that many of those anymore because large businesses aren't creating jobs.
Right. The efficiency being created by Google Apps and other things is reducing the amount, is increasing what people are capable of doing, which means enterprises need less people.
Well, I mean, like Steve Case will tell you, right? All jobs are created by new businesses these days, businesses that have been started in the last 5 years. If that's the case, we need more businesses being started. And, Upstart, the notion is, can we use data and algorithms to actually inject risk capital into the economy at massive scale, billions and billions of dollars, and handing it in small bits to people who are statistically likely to do interesting things with it. That's the hypothesis of the company.
So it's angel list before you have an idea? Angel list before you've formed a company? Is this like angel list to prepare people to be founders?
I think
we're think about it in relation to like an angel list being out there.
Well, I think we're one part angel list, one part Kickstarter, one part lending club. even another part Kiva if you want, because
Kiva for Americans.
Yeah. It's a crowdfunding platform. You raise money, and we have a formula that will statistically predict your income over the next 10 years.
Wow.
And then we impute a return to your. We turn that into today dollars by imputing a return to your backers, and then you go out there and you say, "Hi, I'm Jason. I'm raising $30,000. In return, I'm promising to share 3.2% of my income with my backers," and then the backers contribute just the same way they do on Kickstarter. They're getting some tiny slice of your income. So there's real, unlike these crowdfunding platforms, there's actually economics behind it. It's not your name and the credits of the indie film. It's actually a financial return based on the statistical income of an individual.
How does it legally work? Because we've heard a lot about crowdfunding for non-accredited investors. Of course, the Startup Act, which Obama did pass, has not been executed on completely by the SEC. So crowdfunding for non-accredited investors, investors who make under a certain, or investors who basically are not millionaires, they can't invest because they're non-accredited. Does this fall under like an accredited versus non-accredited investment type thing, or is this a personal loan? How does it mechanically, legally work?
So just the basics on it, we're kind of structured in many ways like Lending Club. So what we have is we're the intermediary. There's no contract between the parties. The people raising capital have an agreement with us to repay that amount to us, and we have what we call payment-dependent notes that we issue to the investors. For now, every backer on Upstart is an accredited investor. That's the first thing we ask you if you go to sign up is, are you accredited? And we go through that process. So we're limited to people that fall under that. It's an SEC regulation, but we do anticipate, hopefully in the next year, that we're going to go through actually an SEC registration. We would like to make this available to people who are not accredited, because I think it's really important when you're raising capital on a platform like this that you can bring your own network in to help get you started.
Right. So I can tweet or I can email people and say, hey, I am trying to lower my risk. Well, I'm trying to lower my debt and spend a year working this apprenticeship and going to General Assembly and become a coder. And I hope in 9 months I'll be a coder who makes $100,000 a year, and that $30,000 paid back over 3% paid back over 10 years. If I make $100,000 a year, it'll be $30,000.
So the funding rate, that 3% for 30,000, varies enormously. It can be, the way we call it, the funding rate is how much can you raise today for 1% of your income, and that's anywhere from about $4,000 to about $20,000.
And that's on a 10-year run rate. Is that how you do it?
Yeah, the recipient has to repay for 10 years, with the only twist being if you have a year that you earn less than $30,000, you don't share anything. So we're not. But the term
not cutting into bone.
Right, not cutting into bone, but the term extends a year up to 15. So think of it as you're starting a company and you're not drawing salary. You're taking a year off because you're taking care of a sick parent. You're having a child. Doesn't matter. The whole notion of income-based repayment is it's flexible. If you don't work, you don't pay. And so it's kind of a equity-like instrument, but it has the flexible notion for people whose income stream may be unpredictable.
So the people who are going to do this investment, obviously one category might be mom, dad, uncles, cousins, brothers, family members, and friends.
That's right.
But then there are people who are going to be investing in this because they think they're going to get a better return overall than the stock market. Is that correct?
Well, we think that the return that we sort of plug into the formula, if you will, is about 8%. So that means if the people you back...
That's double a muni bond.
Well, yeah. I mean, we actually think it's an attractive sort of risk versus volatility profile, because if you think about it, startups, you invest in startups, most of them go out of business, as you know. But the people that worked at those startups move on to the next thing. So investing in somebody's income stream has a far lower volatility. And if you invest in, say, a whole bunch of people's income streams, you start to look more and more like wages in the U.S. economy, which actually has very low volatility, certainly relative to equity, U.S. equities, things like that.
Sure.
So yeah, we actually think it has an attractive kind of risk-reward thing. But the fun part actually is you can affect the outcome. When you back somebody in Upstart, you can offer to be a mentor or an advisor.
So there is a huge value add. If I get Mark Cuban, and you have Mark Cuban as an investor,
That's right.
He's the ultimate contrarian.
Yeah.
So he decides he's going to put $1 million into 100 people, 10,000. Well, no, 1,000 people, 10,000 at a pop? No, that'd be 10 million. So yeah, 100 people at 10,000 a pop for $1 million. Then he might actually tweet their resume or give them advice.
Yeah, I mean, that's an extreme case, right? Mark only has
Mark's
so many
busy.
hours in his day, and he runs a basketball team, all that. But think of it at a more basic level. I mean, people that have done what you've aiming to do, they've done it before. They can make an introduction. And we're already seeing that the upstarts on our platform today are seeing great value from their backers. They're getting introductions. They're getting advice. And if you think about it, just increasing the win rate of whatever it is they're doing, looking for a job, starting a company, what have you, increasing the win rate a few percentage points actually means you can break the curve and you benefit from it.
And the benefit, walk me through a scenario where I put in $10,000. I did back to my nephew, and wants to become a video, editor or something, and he wants to go to video editing school for $5,000. He's going to have to take, a year off, so he needs living expenses. So I give him $10,000. And I get 2% of his earnings, and he's going to make $60,000, $50,000 a year for whatever number of years. But he decides he's going to break out. He works at a video startup, and he gets $100,000 or he makes $1 million in options or something.
Right.
Do I have access to his complete comp? Like if he had stock options, and do I hit a home run then?
So what the upstarts are committed to sharing is their total income line on their 1040. So that includes not just wages, but also realized capital gains. So it's the total income line 22 of your 1040 to be real specific. So that means
1040 is income.
Yes.
So if they get an inheritance, it doesn't count.
No, inheritance does not flow through your 1040.
Yeah.
Now, if you had an inheritance and it had gains that you realized, that would flow through your 1040.
Great.
But inheritance itself would not. But we should say also there is a cap. This is not designed to be the hunt for the next Zuckerberg. We want you to do well, but we also don't want to create something that feels Las Vegas-like. So you
well, that kind of kills it for me. I'm a gambler. I want to get this. I want to invest in Zuck and get 1% of that 1040 line.
Well, the trick, of course, for me was that the cap ensures more people want to play. It means that because without the cap, what I found really early on is the people who are really confident in themselves said, "I'm going to overpay for this money. I am the next Zuckerberg, so I don't want to."
So you don't want to actually disincentivize the next Zuckerberg from using the platform. So what is the cap? If I put in 10,000, what's the most I can return over 10 years?
If you put in 10,000, you can return 50,000. So it's a 5x cap on what you. In order to put it from the recipients, the upstart's perspective, they can never pay back more than 5x what they raise.
Which seems reasonable to me, because the stock market you double your money every 6, 7, 8 years. So I would expect in the stock market I make 25K on my 10, maybe.
Right.
Is that about right?
Don't ask me about the stock market.
I'm just thinking compounding interest of 5, 6, 7, 8% a year. So there's a little controversy. People look at the idea, and I guess in the worst interpretation, the word indentured servitude would come up. Mm-hmm. You've had people say this. I think those are people maybe who don't fully read the prospectus. They don't understand the cap. They don't understand how it works. They don't understand that it's opt-in or opt-in on all sides, double opt-in. But how do you build a startup this innovative when you have people throwing those kind of daggers at you? Like, is this indentured servitude again?
Well, I always feel like a little bit of controversy is great for awareness.
Yeah.
And I'm pretty confident anybody who spends even 5 minutes on our site understanding how it works, what it's doing for people, that sort of sense goes away. But there's no question the idea that repayment is indexed to your income. That's the nice way to say it. The bad way to say it is somebody owns a portion of your income. That sounds terrible.
Right.
But in reality, income-based repayment is popping up everywhere. It's how student loans are repaid in the UK and Australia. It's
do they really do it that way?
Yeah, government loans in other countries, the repayment can be entirely based on your income. In fact, the Obama administration has pushed this in the US. There is now income-based repayment of student loans under certain conditions. definitions.
Well, when you go bankrupt, isn't that what happens as well? Like they look at your income and they say, "Oh, what can you reasonably pay back?"
Well, if you think about it, the number one cause of people defaulting on student loans is lack of affordability. Really simple, right? You have a huge $100,000 in debt, and your income does not support the repayment of that debt. So we, by definition, eliminate that. If it's only 3% of your income, it's only 3% of your income.
Right.
So by applying math to the problem, we've said, look, we can make this conceptually always affordable, and that's why we believe our default rates will be much better.
How many people have you actually closed a loan for, and what's the average loan look like?
We've published about, so we opened the platform in November, this past November. We have published about 90 profiles to the site. We have a few thousand that have applied, but we're being very particular.
So 9% got through.
Yeah, the rest are a lot didn't get through, and a lot are in process.
Right.
But yeah, about 90 have published, and of those, about half have funded. Most of the rest are in funding,
Okay.
and really less than 10 have failed to fund at this point.
Okay.
But it is a model where, we don't decide who gets funded. We put you on the platform, but then your backers have to decide.
In the same way that Kickstarter does.
Yeah, the only difference is we are not an all or nothing platform. So as long as you raise more than $10,000, you can accept it, and then you set your own max based on how much you're willing to share.
How do you know people are spending this intelligently on things that will be accretive to their career and future revenue prospects?
Well, that's a really good question. I mean, first of all, legally we don't. So, if somebody wants to do something real dumb in Las Vegas or somewhere else with the money, then, they're going to do that because it's not a legal thing. But, the social part of this product is really important. We said from the beginning, we're not Wells Fargo. So when you have people, some of which you might know, and hopefully ones that you respect, who have provided that capital, and you've told them up front, why you want the money, what you intend to do with it, I think the social pressure of really doing the right thing is there. And yeah, will we have our Airbnb moment, if you will?
Yeah.
We'll probably have that. We're hoping it's 2 or 3 years down the road, not next week.
And by Airbnb moment, you mean when tweakers come to your house and trash it, which some people speculated Airbnb.
Or somebody buys a car, in our case, and posts a picture of it on Facebook or something.
Right. Or they go enter the World Series of Poker.
That would be another one.
Which is what I would do. That's what I'm doing on this platform. The government has bailed out banks to the tune of tens of billions of dollars, automotive companies for billions of dollars, insurance companies for tens of billions of dollars. Why wouldn't our government give you $1 billion to top off the top third, so people who get to 70% of their goal, the last third the government does, as opposed to just burning money, which they seem to do, every day of the year? This seems like the most efficient way our government could actually help create jobs and create startups, and actually, instead of just paying off rich bankers for the disastrous treachery and pillaging that they've done over the last decade in our country, why wouldn't the government earmark $1 billion for you? Or should they?
So what I would generally say is, look, we're a private market solution. We don't need money from the government. We do need help from the government, and the form
What help do you need? Yeah.
Well, we're in a highly regulated business on both sides of the market. On the consumer side, the sort of recipient side, you have all the consumer lending laws, and a lot of those laws were never designed with something like this in mind. So, for example, if you have to have your APR written in 48-point font or whatever it is, very clearly spelled out, we don't have an APR because we're not interest rate defined. So, now we've actually been working with a lot of agencies, but this is where the government could help. And on the other side, if somebody agrees to pay back 2% of their income, well, the IRS could really make that easy for us to do if they wanted to. And in fact, this is the way it works in the UK. You can actually with your own, you can sign something so that it would be withdrawn from your...
Oh, garnish.
Yeah, basically. Garnished, in effect. Though that term kind of means something else.
Garnish has you did something wrong. It would be earmarked. It would be automatically paid.
It just made it easy for these types of funding agreements to work. And there's certainly ways the government could help on that side. And then, so, generally, I don't think we need capital from the government. I think if we design this thing right, the capital markets do the right thing.
Do you think somebody like a Google or a Facebook who needs high-tech workers would say anybody going for a STEM degree, going to General Assembly, going to Code Academy, two different sites, Google might say, hey, if you raise the first half, we'll raise the second half just to build a relationship with you?
So this is an affinity model, which means you can put your money behind whatever you want. If you want people to study computer science or learn to code, you could easily, whether you're Google or whether you're anybody, say, I want to put money behind people learning to code. Or if you want to put your money behind people going into teaching, you could do that as well. So this is an affinity model, and the beauty of it is it's not a blind investment. You get to choose either by individual or by class, if you will, the types of things you want to support. So we are looking for different ways to match funding from individuals who would bring their own capital there to organizations or other types of institutions that could say, we care about sustainability, we care about teaching, we care about entrepreneurs going into not-for-profit businesses. So these are all ways that we think we can create more liquidity in the market.
A year from now, if you execute perfectly, what will be true about Upstart?
I think for us, we have to prove this business out in terms of scaling it up. We want to get thousands of people funded. The success stories need to come out, and they are coming out, meaning people are getting businesses off the ground. They're getting to do things they would not have been able to do. Our repayments are good. So far, we have 100% compliance on repayment. So
wow.
It's very early. It's only a couple months in.
What do you attribute that to?
Well, it's funny, some people, you don't know what the attitude's going to be, but what we have seen signals of is, I had one of the Upstarts say God, I really want to show those backers that this was a smart thing to do.
Pride.
Pride. You're
and loyalty.
You're on a public stage in some sense of I joined this thing, I took money from them. The other thing is I found incredible sensitivity about not spending the money. And we actually had an Upstart the other week that called us and said, I really want to go to this conference, but it's across the country, and it would be a $300 airfare, and I don't know if I should. And I'm thinking, why are you asking us? That's not,
Yeah.
But the sensitivity of this is something where this is about building a career. This is about investing in yourself, and hopefully that will scale. That sort of idea that I want to use the money in a smart manner, and I want to show the backers that I was a smart investment. Our challenge is we have to be able to do that with, tens or hundreds of thousands of participants, not 100.
So next year, success would be a year from now, you get a major A round. Was this an A round?
Yeah, we did an A round.
We did an A round. So a year from now, on your list of accomplishments, you hope to have maybe a B round, and how many students how many Upstarts Upstarts will have been processed through the system?
We would like to have thousands of people by
Wow.
that time. Or at least I should say 1,000. I shouldn't maybe, but it's hard to guess. When you're in a two-sided marketplace, you have this constant supply-demand thing that almost anybody in this type of business knows, where they have to kind of grow in lockstep, or else it just doesn't work. So we're, for us, it's about making it work properly as opposed to exactly how fast it scales. We mentioned Airbnb, right? They took 3 or 4 years, and boom, all of a sudden it worked, and they took off really fast. And I think that's these types of businesses, you have to be patient. You want to get it right before you try to just scale. Because once you scale, if you have it wrong, you have a mismatch in supply demand, whatever, it can go sideways quickly.
Interesting. And I just had a really great question. Sorry, I forgot it. It's such a fascinating idea. The type of people who are attracted to it today, are they artistic or entrepreneurial? What if somebody says, I want to be a rock star? And does that mean there's less chance that you will greenlight them? In other words, are you doing what's easy? It's not really much of a bet or a risk to bet on somebody becoming a developer or a doctor, is it? So how do you, of those 90, are 10 of them saying, I want to be a poet and I want to be an artist? Or do you route around those and say, what, probably not a good idea for you to be on the platform?
No, actually, we want diversity. We covet diversity. And it's actually quite diverse. People you would think of as, engineering, computer science types are probably 25%. It's not nearly as high as you'd think. And by the way, this is really not a Silicon Valley and Cambridge, Massachusetts solution, because people coming out of those schools, meaning Stanford or MIT, et
They
cetera,
don't need a solution.
they have a lot of choices,
Yeah.
right? This is a Main Street solution. And I should say, like, our view is everybody has potential. And to the extent you can measure it and identify it, you can allow them to monetize it. So whether you're a rock star, as long as there's people out there who feel that they can assess, the potential of a rock star, great. That can work on our platform. Or, an artist, an athlete, take your pick. So our view generally is we're the guy in the middle, but as long as there's an affinity for funding people and an ability to choose winners or choose who you think has potential, that's the basis of what we're doing.
But should the return not match the risk? So if I back the rock star and I know it's 1 in 100, but you've limited me to 5x, could the rock star eventually, maybe not in the first product, but in 2.0 or 3.0, could you say, hey, rock star potential is a 10-to-1 bet, a 20-to-1 bet? Like, can I get odds?
Absolutely. So,
because I'm a gambler.
When
I want to bet on the long shots. I want to bet on the movie director.
Well, when I first thought about this, maybe it was the Google influence, I imagined an auction model. So you'd say, hi, I'm Jason. I want to offer 3% of my income. What's it worth to you? And through some sort of reverse Dutch auction, right, it would settle and would say, oh, someone offered me $50,000 for. Now, having said that, for version 1,
too complicated.
Too complicated. So I met my co-founder, Paul Gu, who's a Thiel fellow.
Oh, great.
And Paul was essentially building a regression model to predict somebody's future income for 10 years. And when I saw that, I said, screw the auction. We're doing a fixed price model for now. So we've set the price today for anybody. They don't set their own price. But there is definitely a future when the price can be set by the market. We don't necessarily think of it as being negotiated between parties, because this is kind of a crowdfunding-like solution. But if you can identify talent and you're willing to, make a bid, there's no reason, at least, I don't know if it will be an auction, but a price influenced by the market as opposed to fixed by us, we think makes sense. And certainly for other types of domains where there's not so much data available to try to, create a real price.
Let's talk about businesses doing good and doing well. Is this one of those, like, heartstring, like, it's, we're just trying to help people kind of businesses, or is this going to be a real business with real profits? Is this, eBay and Kickstarter, or is it more like Kiva or somebody who maybe doesn't have aspirations of making a big profit? Another way of saying, how do you make money and how much are you going to make?
Sure. So I think we are a mission-driven business, but we are by no means just there to do good and not great. I mean, maybe it's, again, the Google influence, but Larry Page is always talking about, you want to have the biggest impact in the world, build a huge, successful business that can afford to do incredible things. So we make money like other crowdfunding platforms do. We keep 3% of money at origination, and we have a 0.5% fee we charge to backers annually. And we think there's a lot of other ways to make money over time, but our belief really is that this is the mother of all asset classes. This is, essentially the potential to securitize wages and income in the U.S. in a way that can be enormously productive to the economy. And so we think, in fact, the goal we have for the company that we've sort of loosely said is, over a decade, if we do this right, we should be able to catalyze the creation of 1 million new businesses in the U.S.
Wow.
Just by giving people with potential the chance in terms of a bit of money and people who can, help you be successful. And they won't all be successful first time or even second time, but that sort of access to capital and access to, mentors and advisors done at scale on a platform that can host millions of people, theoretically, is what we're all about.
We did see David Bowie go public.
Yeah, the Bowie bonds.
The Bowie bonds.
Yeah.
What are your thoughts on the eventuality of rock star talent publicly trading? I mean, if in fact you owned 3% of me, could there be a resale market for that 3%? And could this extend to a lifetime?
Those are all possible. I mean, entering into contracts that have lifetime duration to them is kind of a scary thing. So it's not
50-year bonds.
Yeah. Well, it's more like, how do you have the most participation and create the most value? And And aftermarket actually is very valuable because that means there's liquidity. If you put money into something and you can get that money back out, it's more valuable than if that money's theoretically locked up for long. So aftermarkets are good things because they bring liquidity to investors. But, you know, the Bowie bonds, there's been a lot of little corner cases. You've probably heard of some of this. A professional gambler who had written up some of these contracts and for, you know, sharing income, et cetera. So, but it's never been done really. I like to say it's never been done as if computers exist. Never mind that Facebook exists and that, you know, Lending Club exists.
So that social graph actually comes into play both in finding people to invest, but also building massive trust.
Yeah, of course. I mean, you just like a lot of other types of marketplaces, you need real identity. You need to know that people are who they say they are, and you kind of need the commitment that comes with being a real person on the internet and being able to transact and move money around and do all these things. So this business could not have existed 5 years ago. But
why not?
Well, because
the social graph?
Nobody would have trusted it. Nobody would trust that this person is who they say they are. But now, you know, you look at all these marketplaces that are taking off, and there's a lot of trust involved in them. You don't give somebody your car or let someone stay in your apartment, you know, without thinking hard about that. And in the same way, if you're going to actually contribute to someone's money and expect them to repay you over time, that's a big leap to take. And I think, you know, I sort of put Facebook as the beginning of it all because, you know, they decided very early they were focused on real identities, not pseudonyms and all that stuff.
Girouard, continued success with Upstart. The best way to get through the filter is what?
Have a compelling story. I mean, yeah. I mean, first of all, you know, we do have some criteria. You have to be a U.S. citizen, a few things like that, and graduated between 2008 and 2014. Okay. It's kind of how our pricing model requires that. But other than that, I mean, we don't have a GPA you have to achieve or anything like that. We care about interesting stories that are going to, you know, stand out on the platform and get funded.
I think you need to do a partnership with Brilliant.org. I don't know if you know that company, that Social Capital Partnerships, an investor in. I'm happy to be an investor in it as well. But they're basically qualifying how smart people are by putting like really hard math problems up every day and having people around the globe answer them and then challenging them to the next level up. And now they've got like tens of thousands of the smartest people in the world identified by how quickly they can solve like really hard problems. Now, if you could take those people that Brilliant has said, these are people who are in the top, you know, 2% of math ability, top 2% of verbal ability, and then take that credential and put it on their profile, or take the credential of, I've taken Coursera and Udacity and edX's courses on machine learning and artificial intelligence, and I've already completed 5 courses. Those would be the things on a profile that could make it just absolutely.
Absolutely. Identifying potential and talent is a lot like a search engine. It's based on signals, right? Things in your past, things you've done. So whether, you know, if you got into a great school, even if you didn't do well, you got into that school, that actually shows they had a process that you got through. Yeah. And if you go to Udacity and take a course, and that has a very clear indication of your intelligence in one dimension. It doesn't, so none of them are perfect, just like in a search engine, there's no perfect signal. But in aggregation, if you do it right, you actually end up with something useful and predictive. And that's what we're aiming for.
It's a phenomenally good idea, incredibly cutting edge. And I think it's important. I really think what you're doing could transform opportunity. I mean, it really does have that ability to take people based on merit and help them get through that really most difficult time. I had to, identify so much with what you're doing because I had to hustle in those years after college. I paid my own way through school, and I worked 3 or 4 jobs. And if I had the ability to do this, I could have been an entrepreneur maybe 2 or 3 years earlier.
Yeah, I mean, hustling's good, so nothing wrong with that. But giving someone a little bit of buffer, a little economic freedom, taking out some of that stress and saying, de-risking that thing you want to do, we think means a lot more people will choose to do it.
Do you worry that the people without hustle then don't, it's not hard, this, you hear like it's got to be hard, and like entrepreneurship is getting easier and easier with AngelList, crowdfunding, Kickstarter. Do you buy into that it's getting too easy and entrepreneurs are getting soft?
I think if anything, that's a Valley phenomenon. I mean, it's a Bay Area phenomenon, but if you go out to the real world, you find people with awesome ideas, really passionate, but there's just, capital doesn't flow in the communities around the country the way they do in a couple of places. And so the idea generally is, look, we want more capital to flow, and not in a dumb way, not like just throwing money at people or anything like that, but in actually a way driven by data and algorithms that makes sense. And so maybe it's part of this trend that says, look, everything's not going to happen, here in Silicon Valley or in San Francisco, right? Obviously, it's not happening. But the capital doesn't flow enough and smart enough in other parts of the country, other parts of the world.
Is there a mutual fund approach you can take? Like, let's say I just want to put 10 dimes into this, One High Society, $10,000. And I say, I want to just put it $500 at a clip. Give me 20 people who are at the 80th percentile in terms of raising funds. I'll do the finishing fund, as it were, the last couple of $100 or something, and you get 20 people to do that for $100,000. You got a $2 million fund there, and they just do the last 10%, 20%. Have you thought about that? Is that going to be a possibility? Because I think Kiva does that too, or some of these places where you can just give them a chunk of change and they spread out the risk.
Yeah, we're that'll come to our platform over the next few months. So the way we think about that is, you just say, I want every computer science graduate, or I want everybody from University of Michigan where I went to school, or
Wow.
take your pick, take
Brooklyn,
whatever you
my
care
hometown.
about. Yeah, so we're, if you want a zip code, you want women in technology, it doesn't matter.
Wow, so you could even do it gender or some group that's disenfranchised or something.
There's a lot of ways to cut it, but generally, we don't want to force everybody to go through and read every profile if they don't want to. If they want to really just invest in people from their university or from their state or whatever, there's no reason we can't do that.
Does that mean the alumni associations at universities will be plugging into this platform and saying, like, hey, support our grads?
Well, I would hope so. I mean,
yeah.
Universities forever put all their muscle into helping people get jobs at big companies, right?
Well, they got to justify those huge fees that they're charging people.
Well, yeah. And now most of the people coming out of schools, they don't want those jobs. They want to be entrepreneurs. They want to start companies. And how does the school get behind that? This is the kind of platform that can do that.
What do you guys take? Like 20% of the carry, like a VC fund or something? How do you?
No, not at all. No, we keep 3% of the money that's raised at the front.
Oh, okay. So an origination fee.
Yeah, the origination, and then a half.
Which probably just covers your cost.
Yeah, I mean, we think
overhead.
We think it can be profitable at scale. I mean, it's the basis of Lending Club, Prosper.
Yeah. So somebody raises $20,000, you get $600 to originate that loan.
That's right.
Now, how do you make the real money?
And then we charge 0.5% annually to the backer on the amount invested. So it's like a service fee. Think of it as an inexpensive mutual fund.
5% of the life of it or something.
That's right. And there's a lot of other ways.
1,000. So about $1,300 of $20,000 you're going to get.
Right. That's right.
And hopefully the person who's lending, they're probably going to just want to get their money back. And maybe if they get something comparable to what they're getting on the other part of their portfolio, they'll be happy.
Well, we'll see. I mean, we want to see. I think the upstarts would love to pay more because that means they're being successful, and that's kind of the beauty of the system.
It's like I put a little money aside for my nephew, and it's like he's going to college next year, and I just wrote about this. Like, I was like, well, you're either like this is going to cover 2 years of your school, or it could cover like you going to trade school and taking a year or two and doing an apprenticeship. Like, and I talked to his dad, my brother, and I was like, should I have this conversation with him or? He's like, no, just let him go to college. I was like, all right, he's your kid. He's just going to school, and I got the first 2 years covered. But it's really interesting because I think everybody's got that rich uncle or cousin or whatever who wants to help.
Right.
But you don't want to. You want to do it intelligently, right? I mean, that's...
Well, one of the things, Jessica Jackley just became an advisor to us, one of the co-founder of Kiva. Oh. And, what she talks about all the time is a gift can be great, but there's really something that needs to get paid back. It really changes the notion and creates responsibility, and it makes people feel right about it. So as much as it is good to say, here's money for your books or here's money for your tuition, in a lot of ways, having the person receiving the money have accountability to it and responsibility for it is a better dynamic, we think. And so maybe a lot of that money that goes informally out there to the family members or what have you, this could be a great platform for it because you can combine money from your own network, your own family, with money from others who believe in you.
Awesome. Hey, listen, Dave Girouard is at Dave Girouard, Girouard. And are you at Upstart on Twitter or
We're
Upstart?
at Team Upstart.
At Team Upstart, really good hack there. You got to get that Upstart, get your trademark filed, and then
we've been trying.
Oh, really? Some dude's got it.
It's a gal, but it's okay.
Listen, to the gal who has at Upstart, this is a message to make sure Brandis gets tweeted from the This Week in Startups account, please. Thank you, Brandis. This is a message to the gal who's got at Upstart. Please give Dave the handle. In exchange, he is going to give you $1,500 in consulting fees to teach him how to use the Twitter handle, since you can't sell a Twitter handle. That $1,500 in consulting fees is well worth your time, and he's also going to give you 100 shares in the company, so you have a little bit of unlimited upside. Sound a good deal?
Sounds like a deal.
All right, I closed it. There you go. Making things happen on This Week in
Jason.
Startups. I got at Inside in a similar fashion.
That's great.
Because the guy who had at Inside wanted to sell it to me, and I was like, by the way, you know that you can't sell a Twitter handle, but I can give you a consulting fee for teaching me how to use it and teaching me how social media works.
Working the system.
Why don't they have like a marketplace for Twitter handles? They should just allow a marketplace to
I
sell them.
asked him about that. I have some.
They make
good,
it so much easier.
I have some good former Google people at Twitter who I asked about that, and it's just not a priority. They're actually playing down the Twitter handles, if you've noticed. I mean,
no, I know. Now it's like typing a name when you're doing the app. If you just type in like Bob Dylan, it doesn't do at Bob Dylan. It looks through the directory at who's the Bob Dylan with the most followers.
Well, even the interface itself, the Twitter handle is grayed out and small,
Yeah.
and the real name is big and bold.
Right. It's very interesting. All right. Listen, Dave, great job on the program. Everybody check out upstart.com. Everybody tweet about it. And thank you to my friend Scott Ed Walker at Scott Ed Walker. And you really have done a great job, Scott, of helping me get all these great startups and sharing their stories. Dave, really, thank you also for Google Apps. 310-288-6667. 310-288-6667 for my good friend Scott Walker. We'll see you next time on This Week in Startups.